Welcome. Thanks for joining. I'm Carrie Hayes, a realtor with Block and Lot Real Estate, as well as an active real estate investor. This presentation will help explain how you can save thousands of dollars in taxes while growing your wealth through investing in short-term rentals. My husband and I have been actively investing in real estate for over 5 years. We renovate and sell houses, have invested in long-term rentals, it's not my favorite asset class, and purchase and operate short-term rentals, more commonly referred to as Airbnbs. I'm a licensed real estate agent in Kentucky and have spent hundreds of hours learning the ins and outs of short-term rental investing. I'm not a registered investment, legal, or tax advisor, and all of the information I'm sharing with you is based on personal experience and research. With so many avenues for investing, you may be wondering why real estate? Well, the answer to that is there's no other investment avenue that provides the asset growth and tax advantages of real estate. Over the last 2 centuries, 90% of the world's millionaires have been created by investing in real estate. Leverage is a key component of investing wealth through real estate. What do I mean by that? With a minimal down payment, say 20% of a property, you can take advantage of tax deductions and appreciations on the entire value of the asset. As I continue, I will show you how a $70,000 down payment on a $350,000 property can produce a 1-year return of almost $114,000 for you. We all expect our investments to appreciate in value over time. Real estate's no different. The average year-over-year appreciation for homes in the United States in the past 30 years is 4.57%. In the graphs shown from tradingeconomics.com, you'll see the only negative home price appreciation was around 2008 in a short period following. The 2008 housing crisis was fueled by lax lending standards, which resulted in speculative buying and overbuilding. Although we have seen significant price appreciation since the COVID pandemic, the reasons are very different from the rapid appreciation in 2008. New home construction has been declining for the past decade, decreasing the supply of houses for sale, while at the same time the demand for houses from the millennials and investors for rentals soared. Let's put the information from the first few slides into practice. Say you purchase a $350,000 home as an investment property. You put 20% down, which is $70,000. Using the average home price appreciation of 4.97% in the United States, in 10 years, that $350,000 home is now worth $547,000, or $197,000 more than you paid for it. This house is an investment, so we're going to assume that the rental income you've received over the past 10 years covered the expenses, the mortgage, maintenance, repairs, and management. After 10 years, $57,000 of the mortgage debt has been paid by the rental income. So you invested $70,000 of your own money 10 years ago. Now you have an asset worth $254,000 more than what you put into it. Why is it that if the stock market's average return is higher than home appreciation, that you end up with a higher valued asset? Well, the answer to that is leverage. The growth of your stock market investment can only be on the $70,000 initial investment and the annual growth returns on top of that. However, real estate appreciation is based on the full value of the asset, not just the investment that you put in. So we've talked about appreciation, the increase of an asset's value over time. Now let's talk about the opposite of that, depreciation. Depreciation is an accounting method used to allocate the cost of an asset over its useful life. The easiest way to explain this is to think about carpet or windows. If you put carpet in your house, you don't expect it to last 100 years. In fact, the useful life of carpet is about 5 years. Windows will last about 20 years, a roof maybe 15 to 30. Over time, the value of those components decreases, or in IRS terms, depreciates. According to the IRS, land, on the other hand, never depreciates. So if you buy that $350,000 house, you have to subtract the value of the land from the purchase price to determine the value of the improvement, or basically the structure on the property that will depreciate. For residential property, the IRS has determined that the useful life of a house is 27 and a half years. You can take the value of the house itself, let's say $300,000, and divide it by 27.5 to get an annual depreciation rate. There's also a way to take that same house and break apart its components and determine each component's useful life, 1, 5, 15, or 27.5 years. This process is done through a cost segregation study. A cost segregation study, also known as cost seg, allows you to accelerate depreciation. When a cost seg is performed, an engineer evaluates all the aspects of a property and assigns a cost to those components. For example, the lighting, flooring, roof, walls, countertops, etc. Each component has a useful life of 1, 5, 15, or 27.5 years for residential property, according to the IRS. The engineer then takes the cost assigned for each component and divides it by its useful life to come up with an annual depreciation value. In this example, we're still using that same $350,000 property that has a land value of $50,000. For tax purposes, you could use the straight line depreciation method, meaning you would take the $300,000 improvement value and divide it by 27.5 years. This allows you to write off $10,909 each year in depreciation. Or you could have a cost seg performed. For residential properties, the cost segregation typically accelerates depreciation for 18 to 25% of the value of the improvement. In this example, there's $45,000 worth of 5-year property, $6,000 worth of 15-year property, and $249,000 of 27.5-year property. The 5-year property results in $9,000 annual appreciation. 15-year property is worth $400 in annual appreciation, and the 27.5-year property is worth $9,054. The total year one depreciation, if using a cost segregation, is increased to $18,454 from the $10,909. Now that you understand depreciation and how a cost segregation study can accelerate that depreciation, here's where the really interesting part comes in. As part of the 2017 Tax Cut and Jobs Act that Congress passed, bonus depreciation was put into law. Bonus depreciation allows businesses to immediately deduct a large percentage of the purchase price of eligible assets, which includes real estate. For real estate, assets which have a useful life of 20 years or less are eligible for bonus depreciation. Congress set a phase-out schedule for bonus depreciation. The assets placed into service between September 2017 and December 31st, 2022 were eligible for 100% bonus depreciation. In 2023, that decreases to 80%, then 60% in 2024, 40% in 2025, 20% in 2026, and back to zero in 2027, unless Congress decides to extend these. You may be asking why this matters at all. So let's build on our previous examples. Let's take a look at why bonus depreciation is so important. Again, we're using that same $350,000 property with a $50,000 land value. Straight line depreciation is $10,909 per year for 27.5 years. With a cost segregation study, you can accelerate the depreciation deduction to an estimated $18,454. Now let's see how the bonus depreciation helps. Remember that this house had $54,000 in 5-year property. In 2023, you can deduct 80% of the assets with a 5-year useful life in year one. That's $43,200 in deductions for that 5-year property bucket. The 15-year property is also eligible for bonus depreciation, so you can take 80% of the $6,000 in year one. The $240,000 worth of assets with a useful life of 27.5 years is not eligible for bonus depreciation. So you continue to take the $8,727 per year for the 27.5-year property bucket. Adding this together, you'd be allowed to deduct $56,727 in depreciation expenses in the first year the property was in service. I want to take a moment to illustrate the advantages of high-value properties. There's an increased tax advantage as well as appreciation on more expensive properties. This is the same table as we just reviewed, but these estimates are based on a $1,250,000 property with $250,000 in land value. I was thinking of a nice beach house when I was working through this. Using straight line depreciation, you could deduct $36,363 per year for the 27 and a half years. However, with the cost segregation and bonus depreciation in play, the depreciation deduction would be approximately $189,000 in the first year. Thinking about the time value of money, a dollar saved today is worth more than a dollar saved tomorrow. Even excluding this past year of crazy inflation rates, the average U.S. annual inflation rate is 3.8% per year from 1960 through 2021. So now I've covered the basics for appreciation and depreciation. But in order to take advantage of the tax deductions, it's important to understand how the IRS classifies income. There are two types of income, non-passive income and passive income. Non-passive income is money you earn for an activity in which you materially participate. If you're an employee and receive a W-2 at the end of the year, that is non-passive income. If you own a business in which you're involved in the management and operation of, that income is also non-passive income. Passive income, on the other hand, is exactly what it sounds like. Money earned from passive activities, meaning things that don't require a lot of your time. Investment income from stocks and mutual funds is passive income. By default, rental income is also passive income. Have you ever heard people refer to rental income as mailbox money? That is because it generally doesn't require a lot of time or effort to earn. Think of these two types of income as being in two separate buckets or bank accounts. Rental income, by default, is considered passive by the IRS. Why does it matter if rental income is passive or non-passive? Well, in order to deduct expenses from income, they must be of the same type. Remember when I said think of them as two separate bank accounts? One can't offset the other. Deductions for passive activities can only offset income from passive activities. Deductions from non-passive activities can offset income from non-passive activities. The wages you earn at your job are non-passive, so you need rental income to be considered non-passive as well. There are only two ways to make rental income a non-passive activity. The first is by obtaining real estate professional status. If you work a full-time job of 2,080 hours per year, you would need to work in real estate at least 2,081 hours per year. Because of this, it's generally not a viable option for anyone working full-time outside of real estate to obtain real estate professional status. However, if you're married and your spouse doesn't have a full-time job, let's talk about the possibility. The second way is through short-term rentals. Treasury Regulations Section 1.469-1T gives an exception to rental activity if the average stay is 7 days or less. There are still requirements for material participation that must be met, but this exception opens the door for income and deductions on short-term rentals to be non-passive. What is a short-term rental? The most common term you may hear is an Airbnb. While Airbnb did revolutionize the industry and bring it to the masses, short-term rentals have been around for decades. Have you ever rented a vacation home through a vacation rental agency? That's a short-term rental. They're residential properties that are fully furnished with everything a guest may need during their stay. The average customer's stay must be 7 nights or less. So we've discussed the benefits of home appreciation and even depreciation, but owning a short-term rental offers so many more tax deductions. As a W-2 employee, you're extremely limited in the tax deductions available to you. Generally, you may only deduct your 401k contributions, your HSA or FSA contributions, and charitable gifts. However, as an owner of a short-term rental, you essentially become a small business owner. Deductions related to the property include depreciation, mortgage interest, repairs and maintenance, utility cost, property taxes, insurance, cleaning fees, furnishings, marketing expenses, travel to and from the property. You may also be eligible to deduct home office expenses, educational costs related to property management and rentals, business meals, and board meeting expenses. Let's look at an example of what a difference owning a short-term rental can have on your federal income tax bill. A W-2 employee who earns $500,000 per year maxes out their 401k with $22,500 in contributions per year, and maxes out their HSA contribution with $7,750 per year, and also contributes $25,000 to charity, will have a net taxable income of $444,750 per year. This falls into the 32% tax bracket, which results in $99,984 in federal taxes due. That same W-2 employee who makes all the same tax-deductible contributions, but also bought a $350,000 short-term rental property, would be eligible for many additional tax deductions. Let's say the depreciation was about $56,000. They took a home office deduction of just $1,500, spent $3,000 through the year traveling to and from the property. The owner was tax smart and combined a family vacation with their annual board meeting and was able to write off $8,000 related to that. The owner also spent just $100 per month eating out while discussing their investment with a spouse or an advisor. So there's another $1,200 deduction. In this scenario, I actually used a net zero cash flow, meaning the property just covered its expenses. However, most short-term rentals can produce positive cash flow if care is taken during the selection and the management of them. With these additional write-offs, the owner of the short-term rental is able to reduce their taxable income to $374,323, which results in a federal tax liability of $77,447 instead of the $99,984. That's a $22,537 tax savings in the first year of ownership. Now that we've reviewed a lot of details, let's talk about how this type of investment can affect your overall financial wealth. Based on the example we've been using throughout, you purchase a $350,000 property with 20% down, so you have a $70,000 cash outlay. Using an average of 4.9% yearly appreciation, that same home is worth $367,395 after the first year. By turning it into a short-term rental and taking advantage of the tax deductions you're eligible for, you save $22,537 in federal taxes. You've used the rental income generated to pay the mortgage, and in the first year, $3,930 in principal has been paid. At the end of the first year, you now have just over $113,000 in equity and tax savings. After 10 years, the property should be worth about $547,000. You will have saved $99,000 in taxes and $57,000 in principal has been paid. Your total equity and tax savings on your $70,000 investment is now $423,058. As a reminder, that same $70,000 investment in the stock market would be worth just $178,450 after 10 years. That's $244,000 more. Remember how we also ran depreciation calculations for a $1.25 million property earlier? The total value of appreciation also becomes more significant for higher priced properties. The tax savings for the $1.25 million property would be about $55,000 in year one, with a 10-year estimate of tax savings over $200,000. And after 10 years, that home's projected to be worth $2,030,000. If you're interested in possibly investing in real estate, I'm here to help you. First and foremost, I'm a licensed real estate agent in Kentucky. However, outside of my home area, I work with other real estate agents that are local to the market you're interested in. This is a very important piece because trust me when I say that agents are not all created equal. Unfortunately, there are many agents that just want to close a deal. They may not look out for your best investment interest, or they may not understand short-term rentals and the regulations and restrictions that go along with them. I screen agents in the areas my clients are looking and work with them throughout the entire buying process. I also assist with property identification. I work with clients to identify their specific interests and investment goals. One client may be more interested with cash flow than appreciation. Another may love to ski and want to be able to use the property for vacations. Every client's needs and goals are different. It's vital to understand those upfront before selecting a market or a specific property. Most importantly, finding the property is just the beginning. I consult with clients to help them get the property up and running and create a successful short-term rental. Working together, this process doesn't have to feel overwhelming or time-consuming. Other agents or coaches may be able to find a property for you or teach you the process, but very few offer the combination of both with a proven track record. I've purchased 12 investment properties, including flips, BRRRRs, which is buy, renovate, rent, and refinance, and short-term rentals. I currently own and operate 4 short-term rentals in Kentucky and South Carolina. Every investment property I've purchased has met or exceeded my projected financial goals. I also understand the financial cost associated with an investment property, ways to maximize the tax advantages, and the revenue projections. I invest in the tools needed to most accurately estimate occupancy, nightly rates, revenue, and expense projections for properties across the United States. I have sources for both furniture and furnishing discounts, easy-to-use lists for setup, and how to automate most of the communication related to guest bookings. By working with me, I can help guide you through the entire process of investing in short-term rentals and growing your financial wealth. Schedule a free one-on-one consultation with me by using the QR code on the screen, or feel free to email me at carrie@balrealestate.com or call or text. Any way you want to reach me, I'm here for you.